Audit Planning and Fieldwork Part 3. Audit Procedures. Audit procedures can be defined as the actions that an auditor takes in acquiring evidence. Specific procedures used to determine whether audit objective is met. It can be used in test of control and substantive test. A list of audit procedures is called an audit program.
Audit test. Tests of control is procedures to test the operating effectiveness of controls in preventing, detecting and correcting material misstatement. Provide reasonable evidence that internal control procedures are being applied as prescribed. An auditor performs tests of control to obtain evidence about whether the control activities of the internal control system are effective. Involves obtaining evidence about design of policies or procedures, operating effectiveness of these policies or procedures, implementation. The tests are designed to provide evidence to support an assessment of control risk at a level below high, indicating reliance on the key's controls.
Substantive procedures. Substantive procedures is procedures to detect material misstatement in account balances, a class of transaction and disclosure of financial statement. Designed to test for monetary, misstatement directly affecting the correctness of financial statement balances, performed on specific transactions and balances to see whether the dollar amount of an account balance is materially misstated. These tests reduce detection risk. Types of substantive test. Firstly, substantive test of transactions or test of details of classes of transactions. Transactions test for errors and fraud in individual transactions. Secondly, substantive test for account balances or test of detail of account balances and disclosures. Ending general ledger balance for statement of financial position item. Thirdly, analytical review procedures. Comparison of recorded amounts to expectations developed by auditor. It involves the study and comparison of relationships between accounting data and related information.
Audit evidence. It is made up of underlying accounting data and corroborating information. Underlying accounting data includes the client's journals, general and subsidiary ledgers and various other records, such as worksheets, which all support cost allocations and bank reconciliations. All these records directly support the financial report assertions, which may be either general or specific.
Sufficiency. Considerations that may affect the auditor's judgment as to the sufficiency of evidence include materiality, risk, economic factors and the size and characteristics of the population. Quantity of audit evidence necessary to provide the auditor with a reasonable basis for an opinion on the financial report, quite often determined by reference to sampling. Procedures selected should provide sufficient appropriate audit evidence for the auditor to form conclusions concerning the validity of individual assertions embodied in the components of the financial report, and to give an audit opinion.
Appropriateness. It relates to the relevance and reliability of the underlying data and corroborating information. Relevance requires that the evidence be pertinent to the auditor's decision related to the assertion being tested. Reliability of evidence is influenced by its source and by its nature. Sources of audit evidence. Firstly, obtained directly by auditor. Secondly, evidence created by management. Thirdly, evidence created by third party. Circumstances that could affect the reliability of information obtained. First, audit evidence is increased when it is obtained from independent sources outside the entity. Second, audit evidence that is generated internally is more reliable when the related controls, imposed by the entity, are effective. Third, audit evidence obtained directly by the auditor is more reliable than audit evidence obtained indirectly or by inference. Fourth, audit evidence in documentary form, whether paper, electronic, or other medium, is more reliable than evidence obtained orally. Fifth, Audit evidence provided by original documents is more reliable than audit evidence provided by photocopies or facsimiles.
Factors that influence the sufficiency and appropriateness of evidence. First is auditor's assessment of the nature and level of inherent risks. Second is the nature of the accounting and internal control systems. Next is materiality of the item being examined. Another factor is experience gained during previous audits. Other than that, results of audit procedures, any fraud or error that have been found. Lastly, sources and reliability of information available.
Types of audit evidence. Physical examination or inspection of tangible assets. Inspection or count of tangible asset, to test existence and eventually provide evidence towards valuation. For example, count petty cash on hand on surprise basis, verify the amount of common stock. Documentation or inspection of records or documents. Examination of clients' documents and records to substantiate the information that should be included in financial statements. For example, examine a sample of 10 suppliers' invoices. There are two categories of document. Firstly, internal documents. Documents prepared and used within a company without going to outside party, such as customer or vendor. For example, punch card, duplicate of sales invoice, copy of office receipt, internal report, purchase requisition. Secondly, external documents. Document either originated by an outside or third party. For example, supplier's invoice, bank statement, validated deposit slip. Observation. The use of the census to evaluate certain activities, usually used by auditors during the study and evaluation of clients' IC. For example, observe the handling of cash, observe whether the storeroom with valuable items always locked. Confirmation from third party or external confirmation. Receipt of written or oral response from an independent third party verifying the accuracy of the information requested. For example, confirm client's cash balance with bank, confirm account receivables balances. There are two types of confirmation. Positive confirmation. Third party respond to auditor regardless whether the amount correct or not. Negative confirmation. Third party respond only if they disagree with stated amount. If no reply received after certain period, auditor may assume the info is correct. Inquiries of the client. Obtain written or oral info from client. For example, inquire with the management whether there are obsolete stocks or collectability of account receivables balances. Recalculation or recomputation. The rechecking of a sample computations and transfers of info made by client during the period under audit. For example, check the calculation of depreciation expenses, accruals or prepayments, recompute invoices amount. Reperformance. Auditor perform procedures in accordance with the client's manual of procedures. Analytical procedure. The use of comparisons and relationships to determine whether the accounts and other data are reasonable. For example, evaluate the reasonableness of receivables by calculating and comparing ratios. Compare expenses % of net sales with prior years.